So with today's inflation report, can we add rate cuts to the list of bullish market indicators, and will that keep this rally going? Well, joining us now is Renaissance Macro Research Head of U.S. Economics, Neil Dutta, and Evans May Wealth Managing Partner, Brooke May. Great to have you both here. And Brooke, I'm going to kick this conversation off with you because so far earnings season has been incredibly strong when you look at these beat rates, much higher than we've seen previously and historically when it comes to EPS numbers and revenue. What's your takeaway?
I think that management's had to be cautious. There's been a lot of uncertainty this year around, what tariffs would be, what AI innovations would occur. And so when businesses give guidance, they've erred on the side of caution because being wrong or overestimating can be punitive. So what we're seeing now is that companies have figured out how to navigate this environment. And tariffs haven't been as crippling as we anticipated. And there's more clarity than there was at the beginning of the year. So with cautious guidance, we're getting, beats right now. 87% of companies beating is stellar. However, not all companies are. When you look at financials, for example, big banks like JP Morgan, Bank of America, Goldman Sachs, Morgan Stanley have all had stellar reports. But you look at other areas like regional banks where there are concerns around credit losses, or even Blackstone this week. There's disappointment. So you really have to look right now at the individual companies that you're buying and not necessarily just at an individual sector.
Neil, how does CPI factor in, especially when, particularly on the services side today, when you look at core CPI, it came in cooler than expected?
Yeah, well, I think it sort of cements a rate cut. I mean, I don't think there's really any debate about that, Morgan. I mean, last year, inflation ran 3%. And so far this year, it's running 3% despite meaningful upward pressure from tariffs. So what does that tell you? It tells me that underlying inflation is actually lower than people think, which is why the Fed has the space to continue cutting interest rates. So I think not only are they going to be cutting next week, but I think it's highly likely that they'll be cutting once again in December. To me, the real risk is how we should be thinking about 2026. I mean, you have to assume that the government will reopen at some point, and we start to see, the data dripping out. And I suspect it'll tell us that the economy is, somewhat weaker than the GDP statistics show in the third quarter. And that, to me, leaves me, more bullish, frankly, on the long end of the Treasury yield curve here.
Okay. Brooke, you point out that the equal weight S&P is trading at only around 17 times earnings. So if you're one of those investors who has maybe ridden the broader market up this far, what does that say about how you might rebalance or how to think about where the gains are going to come from here?
I don't know that I would rebalance. I think that it justifies, though, the elevated PE that we're seeing. When we look at the beginning of 2025, we were trading around 22 times on PE on the market, and we're around that level still. So yes, the market is elevated, but when you look at the Mag 7 or the biggest weighted names in the S&P 500, that's where the earnings are. We think that the S&P 500, we think that right now the Mag 7 earnings could be up about 15% this quarter, year over year. But when you look last quarter, they were expected to be up about 15%, and they were up about 26%. So you've got to follow the earnings. So yes, we're trading at an elevated PE, but the market can trade at an elevated PE for a prolonged period of time. And if the earnings are there to justify it, the market can continue to move higher.